Hi everybody, this is Phil Holoka from Complete Captive Management Services. Today we're talking about comparing financial statements between a fronted captive and a direct writer captive. So this looks like a balance sheet. And as you recall from last week, I said the majority of what is important about a captive resides in the balance sheet. Not so much the profit and loss, but mostly the balance sheet. So within the balance sheet, you're going to see assets, and they equal to liabilities plus equity. That's the standard balance sheet equation, for example. Now, for a fronted captive, you have really three different labels as an asset. The first one is common, cash. That's always at the top of the balance sheet. And in this example, $150,000 resides in cash. Then there are two new terms that you're probably not aware of. Reinsurance funds on deposit and reinsurance receivables. So let's talk about them. The reinsurance on deposit simply means that the captive, the group captive, is reporting assets that are being held by the fronting carrier. Okay? We know that a fronted captive does not collect premium. The premium is paid to the fronting carrier. And then the bordereau report, which is created by the fronting carrier, reports the reinsurance funds that the captive records. So the bordereau report captures this number, okay? So those are the dollars that the group captive members are paying to the fronting carrier. Then, reinsurance receivable is the dollars that the fronting carrier is holding today, but they are scheduled to be released back to the captive, which are then labeled underwriting profits. Okay? So when you add up all of these rows, you get $500,000. Now, with a direct writer captive, there is no fronting carrier. Therefore, there are no reinsurance premiums on deposit. This flows right down to the bottom row of assets. Very simple equation. Now, if the direct writer captive participates in a risk pool, and that risk pool requires the cash to be held by the risk pool, then the captive may have a due from as an asset on its balance sheet because the captive that participates in a risk pool no longer holds the cash. In this example, only $500 in cash is being held by the captive, and $499,000 is held by the risk pool. Therefore, in replace of the cash, the captive reports a due from as an asset. Okay, liabilities, loss reserves. These are the reserves that are calculated by the actuary. And let's assume that the calculation is identical for all of the options. Okay, the balance sheet options. So $100,000 of loss reserves. This number is going to adjust, okay? And we're going to talk about next week what's important about this in relation to that. Okay, so loss reserve calculations is the duty of the actuary to post within the balance sheet. Premium tax payable. Every captive has to pay a state premium tax. Therefore, you have to accrue for that. That's what this row is. So when you add the liabilities up, you get $101,000. across all three expressions. And then you come down to equity. Surplus. This is generally going to be the capital that is paid by the members of a group captive. So for example, if the fronting carrier says we need $50 of collateral, the captive may say, okay, we're going to charge our members $75 of capital, and $50 of that capital goes to collateral, to the fronting carrier. That's kind of expressed here. That $25 that remains is expressed as surplus. And then $99,000 is the profit, accumulated earnings, sometimes known as retained earnings. That's being reported there. Now, the difference is the direct writer captive will generally not have a high capitalization requirement because there's no collateral being taken out of that. Therefore, you're going to have a lower number. Because this is a lower number, you're able to have a higher retained earnings within your captive. The same for the direct writer captive that participates in a risk pool. Okay? High level stuff, reinsurance, funds on deposit, and reinsurance receivables, otherwise known as funds withheld. So when you're in a group captive, question, is the fronting carrier requiring the captive to operate on a funds withheld basis? And if they do, which they are likely to do, you're going to see these rows within the group captive's balance sheet. Next week, we're going to talk about how to compare and place value on different group captives. Until then, have a nice day. Bye now.